Welcome, everyone, to episode 7 of the Total Relationship Podcast. I am Kim Cochenour, COO at Form Wealth Advisors, joined by my co host, Tyson Ray, CEO of Form Wealth. The
Yeah,
past four
I'm here.
episodes, yeah, I'm glad you're here, Tyson. In the past 4 episodes, we dedicated our time to just running through the foundation of setting up that client advisor relationship and just that commitment to building a strong foundation. We went through the questions to ask during discovery meetings. And in this episode, we're actually going to take a shift away from that and dig into the planning and more of the portfolio side. So we're going to jump into total relationship investing. We call it TRVest for short. And it's the second pillar of the 3 pillars of the total relationship approach. We're going to get into the difference between performance reports and research, which I know Tyson loves to talk about, and I'm excited for him to dig into that. The data sources that we're paying attention to, and what the industry experts are saying, and how we apply that to our investment decisions. So, hope you enjoy the episode. Let's jump in. Tyson, you hammer home the
Hammer.
different you
Pound
talk
on it.
so much about performance reports and how many advisors really just cling to that. And what we're not talking about today is not performance. We're talking about research. So what is the difference between performance reports and research?
Ugh. Okay, so after 25 years or more than 25 years of doing this business, I keep finding the firms spending millions and millions and millions of dollars on technology to be able to slice and dice the past into some number to be able to somehow justify the value that advisors bringing. And so that's your performance report, right? Compared to what? And then because a diversified portfolio needs to be compared to something, now you got a gazillion different benchmarks or indices that you can go pick. And so an advisor can actually go customize a performance report to actually reflect that they beat something.
They're proof
Uh,
that they did better than one other thing.
yeah,
That's easy to
or
find, right?
yeah, and like the worst thing a client could ever ask for an advisor in a proposal setting of starting a relationship is how have you done? Because without without the client knowing, an advisor can go in the past and build like the perfect portfolio, right? I mean,
Oh
it's
yeah.
just unbelievable because we all have last week's winning lotto numbers, which actually, quite frankly, that would be the best performing investment. Um, and the difference is it's the difference between looking backwards and looking forwards. Now, disclosure, and I'll give credit to Nick Murray for helping me really grasp this. Like, no one knows what the future holds. No one has a crystal ball, right? And when you get into research, the difference between performance is looking backwards and research is looking forwards. We got to start with the understanding that no one knows what the future is going to hold. No one can time the market. No one knows what future rates of return are going to be, and no one knows what the future of the economy is going to be. It's an unknown, but there are trends of the past, and based on what's currently happening, there are a lot of people out there that are basically trying to give guidance of what the future holds, much like the weatherman, right? Most of the weather yesterday is very likely going to be today's weather, and today's weather might just be tomorrow's weather.
And
Because guess
everyone
what?
loves that approach because no one really knows.
Well, it's kind of funny, like it's shocking. It's going to be warm in the summer, right?
Mhm.
But everybody would like to know exactly when it's going to rain, and just like everybody would like to know exactly when the markets are
The
going to
market's
correct, and
gonna
they
go
just
down.
don't know.
Yeah.
But people are sitting down, advisors are sitting down and printing out these beautiful little pie charts with these little graphs, right? And your allocation is this, and these things have done that, and and most clients want to be like, okay, that's great, but I want to buy a car in 6 months, or am I going to run out of money into the future? Um, and not that past performance doesn't give you some kind of benchmark or some kind of guidance, is that, are you keeping up with the returns that are possible? What we find is an advisor needs to first and foremost have kind of a predetermined process or a plan about how they go about building portfolios. And
Mhm.
part of that is taking in research. And then please help yourself, advisor and client, ask for this. Hey, don't hang your hat on any one piece of research because any one analyst or one firm has a bias and can be wrong. And so
Yeah.
we're a firm believer that if you blend several pieces of forward guidance together,
Mhm.
if you take 4 or 5 different weatherman's forecasts for the next week, you might get closer to what reality is going to be. Because again, everybody has a little bit of bias. And the problem is that there are a lot of financial firms out there that
Mhm.
financial advisors are uh, uh, literally employees of the firm, and in some cases trapped to that firm's proprietary research, and that's all they get to build their portfolios off of, or that's the only guidance they get, or they're just lazy and that's the only guidance they'll take in.
Yeah.
And we're a firm believer that no, you need to take in multiple sources of multiple opinions, even of some you don't like, maybe politically or maybe from a value system or whatever it is, because it's all blending together kind of where the world is at
Mhm.
and trying to see what that harmony looks like. I kind of equate it to watching, like, if you if you watch 4 or 5 different news shows these days, they may be talking about the same issue, but they're all
Mhm.
coming at it at different angles or different ways of
Their
looking
own
at it.
bias.
Correct. But by blending them together, you get some reality of what the facts are or what the
Mhm.
or how to make a decision.
Yeah.
And we spend so much more time trying to understand what the future is saying, what the research of going forward looks like, than trying to spend time talking about the past that is perfect and it's known.
Yeah.
Because clients are asking us to invest money into the future. They're not coming us with money saying, "What would you have done with it in the past?"
Yeah. Well, and I think that's part of the advisor's job is to be paying attention to the industry research and looking forward instead of focusing on that past performance. And so for the advisor who's kind of coming into this being like, okay, I work for a firm. All I've done is actually look at just their proprietary information because if they're recommending those products or reading strictly only that research, that might be biased on how they're actually paid. And so, where did you start pulling advice or research from or information from? You already mentioned Nick Murray. What are you paying attention to?
Well, I think first, let me back up. See, I thought it was the advisor's job to pay attention to all this research. And what I'm finding is, and you had to, right? When it was
Hmm.
just me and one staff member or one associate supporting me, or heaven forbid, it's just you, like you got to wear a lot of hats.
Yeah.
And ironically, the better the advisor is at their job in the relationship and the planning, most likely the less they're interested in this research and the investment selection and following the markets. And so partly we had to build within our team and are seeking to help other advisors capitalize on what we have of building a team that handles the research. So the day in, day out advisor that loves the relationship and loves the planning can be equipped with what is that harmony of research saying. Here are the cliff notes. Instead of them having to read the research report themselves, here's the 2 sentences that we think really matter in this report or that report or that report to kind of give a general perspective of what the industry is trying to say so that they can focus on where their unique ability is. And a lot of advisors are trapped trying to do that themselves at the sacrifice, I think, of the planning and the relationship. And so sometimes it's just
Okay.
trying to find other resources that can provide some of this harmony that's out there.
Yeah.
Um, and so for us, it just started with realizing, I think partly it was realizing while in my 25 plus years in this business, I sat at my desk and all of a sudden the firm I was at got bought out by another firm. And so I got to go from our research and then that team left and the new team came in and I got to see that research. And then within a year, that company went under and then another company bought us. And so within like a 3 year period of time, sitting at my same desk with my same computer and my same telephone, I had 3 different experiences which helped me start bias or this firm thought this and now that. And because I changed and followed it, I actually didn't do as well because I wasn't because I went from one bias to another instead of blending them together to realize there really was nothing to do differently.
Mm.
And it's just it's also taking in resources that don't have products attached to it.
Yeah. That's a
There
big
are
one.
firms out there that, oh, there are firms out there that put out research to justify their new idea that is this product you can sell. And here's the prospectus, and here's the information. It's going to sit on your desk. And of course, you took me golfing, or took me out to dinner, or gave me a shirt or a sleeve of golf balls, or brought donuts to the office, or anything to kind of get in my head as a shelf life. Like, you did something for me. So then my human response is I have to do something for you, which is to give back by putting people's money in this said product, because you gave me this piece of research that this is a great idea. And so first and foremost, we try and not use research that is tied back to specific products or to justify specific products. Again, predetermined portfolio has been built, and we understand what the pieces are. Now the research is helping guide how much we should have in the individual pieces. And it's blended together, like we've said, and I can't reiterate it enough, several different pieces of research to communicate to us where that harmony kind of lies with what future look like, what the economy look like, what they think the government's going to be doing, which all blends back into where is the potential going forward versus spending so much time looking at the past.
Yeah. And Tyson, we might not be able to dig into this from the compliance standpoint, but I think it might be really helpful if you actually talk about the data that you actually blend together. Do you want to get into those firms and why these firms and
I
not
don't think,
others?
yeah. So I think the reason I don't want to name the firms that I'm using is because I don't think it matters what firms you use. I think it matters that you
Okay.
use 3 or 4 different. So if you're going to use capital market assumptions, which is a firm's guidance on future rates of return and risk of individual asset classes, I suggest you use 3 or 4 different ones with different time horizons from different companies that are completely unrelated. Blend those together. If you're reading or using research on economic forecast, again, it's 3 or 4 different pieces put together, and it's because the subject matter is usually the same, the topics are the same. An election's
Okay.
coming, right? Or inflation is happening,
Yeah.
or unemployment is there. It's not hard to read 4 of these things quickly, but it does a wonderful job of helping you see. One says go left, one says go right, one says go straight, one says stand there. By blending them together, more often than not, what it's telling us to do is nothing. And
Mm.
in an industry and in a lifestyle that is moving so fast that somehow we always think we got to be doing something,
Yeah,
actually
making a change.
doing, oh, sometimes our an advisor's greatest value, I think, often is to be paid to convince the client not to do something.
Mhm. Well, and do
And
you think often advisors are making changes just to prove that they're doing something for their clients?
I don't think it's just the advisors are doing that. I think firms do that.
Mm.
I think there are moving pieces just to show activity. I mean, there were rules a couple of years ago that to show why you were charging an advisory fee, you had to make trades in the account. Okay, well, what if the right thing to do is not make trades in the account? I mean, Warren Buffett, I just watched his most recent little, annual meeting. He's the epitome of buy and hold. He's the epitome of do research,
Yeah.
make like 8 decisions in your entire lifetime, and then don't deviate from them.
Yeah.
Um, so I don't, and he as well is taking in a lot of different perspectives from a lot of different
Mhm.
places.
Yeah.
It just goes back to, I think it's a mistake to hang your hat. Let me rephrase that. It's a mistake to take people's life savings and make decisions off of one source.
Yeah. Well, and it's the adage of putting all of your eggs in one basket.
Yes, because the risk, what we're trying to do is not be wrong. And what we found is if blended research, if one firm says go left and another firm says go left and another firm says go left, okay, now you might want to deviate your portfolio to the left.
Well, and recently we had an experience in the office where you were digging through some of the research, and one of the firms updated their assumptions. And then what was it?
A
60
month.
days later?
Yeah,
Yeah,
not even.
yeah, they
Yeah.
came back and went right back. So
Yeah.
talk about the impact that actually can have on a client if you're kind of flip-flopping all the time and making those changes in their portfolio.
It just goes back to it's the goal of the advisor is to not be wrong.
Mm.
And if again you're finding, and I have found that any one of these firms can make a change. I remember when unexpectedly in 2016 Trump won the presidency. That wasn't expected. And the next day, one of the resources we use completely changed the portfolio because of that, thinking that there were going to be protectionisms and thinking that things were going to change. You had a lot of clients that maybe wanted to react because their values or their politics wasn't aligned with that outcome. And then ironically and blend the research together, the three other firms didn't make any of these changes. So it blended together and didn't cause us to make a portfolio change. That election result was in November. By January, the markets had moved positively. The change that this firm had made was wrong. They took a step to get back in January. And then 2 months into February, they actually increased their holdings and the things they got out of. And it was just a missed
Wow.
opportunity because they reacted to something. And again, I believe that the markets move based on this really crazy idea. If more people are buying than selling, the market goes up. And if more people are selling than buying, the market goes down. It's amazing how it's just that is actually like if
That
they
sounds
just
like
said that every day.
fundamentals to me.
Yeah, if they just said that every day on these TV shows that show the ticker tapes in the market, like no one would watch, right? It's just
Yeah, I
like
was like,
there's your
no one's
answer. Why?
interested in that. They
Yeah,
don't get
no,
excited about it. No one freaks out
no,
about that.
yeah, but if multiple institutions are buying or multiple institutions are selling into these areas where that harmony is, you're going to
Mhm.
capture most of that move. And the move in these trends we're looking for are not day to day. They're the next 6, 12, 24, 5 years out because trends develop. And so again, the performance reports tell you what has happened when our job is to prepare for what's coming.
Well, and we're going to get a lot into some of the planning in the next episode of how you actually start planning for that future with the client and know what's coming. Um, but I think one of the pieces that's really strong with our team and an emphasis that you have a lot on team is how do you apply those investment decisions to the firm and not being the one person making those decisions. Like, talk about working with an investment committee. I know there's plenty of advisors who they don't have a larger firm. They don't have a larger team, actually, probably that they're a part of to build out an investment committee. But talk about the value in having multiple minds at the table.
Yeah, I think it before you can even do that, you have to create you have to buy into a value system or an idea that Bob Dunwoody taught me years ago.
Hmm. I love
Um,
this example.
yeah, and what he simply said is okay, Mr. Advisor, you have a book of business that has AUM. So what is that? 50 million, 100 million, $1 billion of assets under management. And what he would say is, let's just pretend for a second it's all in cash. It's 100% in cash. And if it was 100% in cash, and this is people's life savings for the future, where should it be? And think about that. And he'd make us kind of write down what our thoughts are. And then he would come back and say, now ask yourself the most important question: why isn't it
Why?
there?
Hmm.
And the reason it's not there is because you either had all these different ideas over your career, which is what created now these assets under management, or even worse, you had the client come in and offer they wanted this position or this stock or this idea or this bond or this cash or this whatever. And your practice has been impregnated with thousands of positions. So much so it's not even manageable
Yeah, how can
because
an
every account
advisor
is,
monitor that?
you can't. And yet the clients think you are. And you tried this
Mm.
program or you tried this investment strategy or you put it in this product or this solution, and then you pivoted and went somewhere else, but you left the 10, 20, 30, 40, 50, 100 clients in the old one because this is now the new thing.
Mm.
And what what that caused us to do early in our career was build predetermined investment strategies. And basically it's finding clients that want to let go of those decisions and allow us then to run models and run investment strategies so we can have a committee to speak into it, because you can't get an investment committee if you have 3,000 positions and no overarching theme for asset allocation across your entire practice.
Yeah. It's too scattered. It's not consistent.
Well, you just don't know what you own. And then quite frankly, early in my career, like I would have an annual review with a client and I would see my ideas from the year before. And now I knew what I was doing today. And I'm like, oh, you idiot. Like, how did you leave them in that? Like you dumb. Oh,
Yeah.
versus now it's consistent across the board. So I'm having an annual review. I know what the portfolio looks like for every client that's in that investment strategy, or as far as that risk return portfolio that we're shooting for. And that's scalable. That's consistent. I think there's integrity in that. And it protects me from letting the client come in and give the one-off idea. And I simply say to them, I can't monitor that because I
Yeah.
can't. If you were my only client, I could do it. But the reality is that you don't have enough money to be my only client, and your family members and your loved ones and these other clients I have, no, I'm not spending any of my time monitoring the one-off
Yeah.
because I can't.
Well, and so
That's no.
that there's no value. Well, but I think that actually speaks really well, Tyson, to the advisor who's wanting to make that switch in their practice. That you don't, until you know better, then you can't move forward. But once you know better, do better. And that's okay that you grow and learn and make different decisions for your business so that you can continue to take care of your clients. But if you realize you're the advisor with thousands of positions in your portfolio and you're like, I'm not actively monitoring that, I can't manage that correctly, this is really important, my client's life savings is important, like, you can talk to your client about that without throwing yourself under the bus in a negative way, but just advocating for what you think is best in their best interest.
So how do you do that, right? So
Yeah.
again, another coach, shout out to Duncan McPherson, back in the 2000s. It was, we literally like shut down our practice. We sent out letters to clients that basically said, for the next 6 months, we're retooling. We're not going to take on any new clients for the next 6 months. We'll make some exceptions for friends and family and death and inheritance and so on and so forth. And it was kind of like, oh, okay, that's interesting. And then we circled back around after we figured this out and okay, if it was all in cash, where would we put it? How would we build it? What would it look like? Then we went back and opened the practice back up, met with every client, and basically allowed them the opportunity to rehire us under these premises. This is what we're going to do going forward. We don't think this was worth doing. We don't think this was adding value. We think this was taking unnecessary risk in different client portfolios. We couldn't monitor all this stuff. And it's all true, right? It's hard
Yeah.
to object to
I was like,
that. Like
that's
I
the
can't,
truth. Yep.
yeah, yeah. I can't call fast enough to get permission from you to make a decision. Heaven forbid you want to think about it or get back to me or want to see the report. Like, that's not working in this day and today environment.
Yeah, it's
And
moving too fast.
most clients thought, yeah, like, no, that's what I thought. Yes. And so it was very easy for us. And it took about a 6-month time to kind of figure out what did our systems want to look like and how do we want to build this. And then about 6 months to take our practice and completely turn it on its head, to take ourselves to a place where now it is manageable, it's consistent, and now we can have overarching themes to drive the portfolios and have a consistent conversation with clients, so that when they're talking to their friends and family and loved ones, they know when they send someone to us, what they're going to get, which isn't the hot
Yeah.
idea. It isn't the trendy thing. It's not going to be this really sexy performance report. It's going to be about their life. What do they need? Because we've basically are managing the money for them and not having to involve them in those decisions, because we built systems and they understand there are systems. They understand Tyson's not like, I'm guessing which direction the wind's going to blow. No,
Yeah.
we're taking a lot of different resources to guide those decisions. And if I drop dead, that could keep going. And that's something else they want to know.
Yeah. Well, and I think one of the things that's really important is that clients are very emotionally tied to their money, right? Because they know that's how they pay their bills. They know that's how they live their life. And they're entrusting a wealth advisor with their life savings, but they're not wanting their advisor to be emotional about investing their life savings. So it helps pull that emotion out of it so that you can have facts and consistency in how you're investing their money, and not letting yourself getting swayed by the news cycle or what the Fed might be like. You're paying attention, but you're not emotionally making decisions based off of it. It's factual.
Well, and the stress these advisors have that have all these positions is what positions are blowing up inside your practice. You don't even know it's happening
Mm,
until you actually sit down with a client and go, oh my gosh, they had pick what it was that then
mhm.
got, cooked their books or did something wrong, especially on the individual stock side. And all those risks you can diversify away.
Yeah.
So when we're sitting down with a client, I'm not worried about what the portfolio looks like. I know what the portfolio looks like because it's the same portfolio strategy for the firm.
Yeah. Well, and that's the biggest part of taking all of the research together, blending it together. The one piece that I think is really important that we hit on is actually adjusting for inflation and just trying to make sure that your client, when they retire, can still afford that cup of coffee 20 years from now, because the unknowns of what that's going to cost. So, how do you build that into TR Vest and account for that?
So TR Vest is the total relationship investment strategy that we created. You could play on it a couple different ways. It's also total risk management, right? And so TRVest again starts with capital market assumptions, which are what are these blended rates of return from these firms going forward, and then taking inflation out of that number. And the reason why that's important is a couple years to COVID, it's like, okay, great, you got 3, 4, 5% on a money market, but if you had 9% inflation, you actually had a negative real return in cash. Felt good, but your purchasing power staying in that for long periods of time, if that inflation stayed that high, doesn't work. And there's been periods, especially the 70s, that were like that. And so the goal, I think, for communicating to the client, the goal is helping the client understand that the only way, historically speaking, you can beat inflation is to take your money, which by definition is units of a currency, and convert those units of money into some other units or some other shares that have the opportunity to grow greater than inflation. And historically speaking, participating in the ownership of companies, that a company is out there to produce a product or service that 8 billion people on the planet are going to want or need or always have. And at the end of the day, produce a profit for the shareholders of that company once those products and services are purchased or consumed, and the sale is made, and it brings back and you pay your employees. And at the end of the day, businesses want to be profitable. Those profits, historically speaking, have created returns greater than inflation, because if the input cost of the product of a tube of toothpaste goes up, then they raise the price of that tube of toothpaste. And at the same time, trying to capture or keep that profit margin they want for the shareholders, which is often greater than the cost. Because if you don't have a profit greater than your cost, you go out of business. It's amazing how it happens, right?
Amazing. Fundamentals again.
Crazy. And so what we're helping clients realize is, and what we have to remind ourselves is that that's the goal and that's the why. It's not to chase some performance. It's not to try and make more money for more money's sake. It's to try and preserve the wealth that someone's accumulated, so the bag of groceries they buy today, they can buy 20 years from now. And it's to move this units of currency into some other type of units that can appreciate over time. And then when the need shows up that we need those dollars again, we can sell those shares, preferably for a profit, preferably in an uptrend, preferably based on this research we're monitoring to know when to do that, convert it back now into more units of money to buy that same product. And that's the most simplest way I've ever been able to communicate for myself and to the client why we're doing what we're doing when it comes to investing and why it works.
Yeah. So, Tyson, as we kind of wrap up, what do you think is a key thing to leave listeners with today?
It's very stressful as an advisor to try and be the advisor that's outperforming something, whatever that something is. And most likely, if you're trying to do that, you keep changing what that something is. And the technology's out there to give you all kinds of benchmarks to show in the past you beat something. And what I would say is that there's a lot less stress in focusing on trying to help clients live a better life and try and help them plan into the future, and let the past be the past. Whatever the performance of the past is what the performance of the past is. If you've used multiple sets of research, so you have a harmony of what the collective world is thinking the future is going to hold, you're going to get the collective average return, which studies show the average investor doesn't get, because I think the average advisor is trying to chase performance. And you can free yourself of all that stress and give the clients the returns that they expect, which is really what the markets are generating, by not hanging your hat on any one firm and by not chasing performance or putting your value add based on performance.
That's great. So thank you everyone for tuning in to episode 7 of the Total Relationship Podcast. Research plays a vital role in making smarter portfolio decisions. So join us for episode 8 as we dive into total relationship investing even more and the advantage of setting up cash reserves for your clients. If you haven't already, make sure you follow or subscribe to know when our new episodes are available. Those are launching every other week. And so you can also check out episode descriptions for links and resources from Tyson and myself over at the Total Relationship page on LinkedIn, especially if you're looking to connect with other like-minded advisors as yourself. Visit us totalrelationship.com. And until next time.